Hello and welcome to Kitco Mining with me, Paul Harris. Gold producers are riding high on elevated metal prices, a perfect time to bring new production online. And joining me today is someone who has done just that, Stephen Dean, Chair and CEO of Artemis Gold. Stephen, welcome back to Kitco.
Paul, always good to be on your program. Thank you.
Now, Artemis has just declared commercial production at its Blackwater Mine in British Columbia on time and on budget. Congratulations there, Stephen. A momentous task. What were the keys to everything going so smoothly? How did you get up to nameplate capacity so quickly when many other companies that build mines struggle to do so?
Yeah, I think the truth is they didn't go always smoothly. The key is to give that appearance and get the job done, and that's the skill base of our team, and the kudos is deserved for that team.
Okay, now Blackwater is set to be a big mine in the current context, a very big mine. What will it eventually produce annually, and how much are you expecting out of it for this year?
Yeah, we've given guidance last week on what we expect for the current full calendar year, the financial year. We produced about 30,000 ounces prior to declaring commercial production, and we're guiding somewhere between 160 and 200,000 post that date during the commercial production period from May 1 through to the end of the year. We're forecasting costs of the order of $670 to $770 all in sustaining costs.
Now, I think eventually you're going to get up to 400,000 ounces a year of production next year. But that all in sustaining cost in the current context, that is really, really low. That puts you pretty much at the front of the cost curve, the first quartile at least. Just looking at the first quarter results that have been the majors have been putting out this week, the average all-in sustaining cost for them is now about $1,500 per ounce. For the mid-tiers, it's about $1,650 an ounce. So I think it's fair to say you're looking at a cash cow here at Blackwater.
Yeah, we're certainly benefiting from the current gold and silver prices. You may recall maybe a couple of years ago, Paul, that I did an impromptu quip and said, in answer to your question, how do you get a low cost tier one large producing gold mine? And I said, you got to build a new one. And that sounded rather glib at the time, but there's a lot of truth in that. Newer gold mines always have lower sustaining costs. They always have lower maintenance. An open pit mine has initially a lower strip because the hole is more shallow. In an underground mine, similarly, you're closer to surface, so your haulage distances from underground are less. So there is a lot of truth in the value of a new and modern gold mine with the latest technology installed, both in terms of process as well as mining, in order to achieve those low cash costs. So we're certainly in the lowest quartile globally, and perhaps even in the lowest decile of costs for large scale mines.
And I think one thing that, take on board a lot of your comments there, Stephen, but one thing is you haven't had to, let's say, breaking or try out new or untested equipment or processes here. You're using standard processes, standard equipment.
We are in the process plant. It's a very, very standard flow sheet. In fact, almost old fashioned. We've got a 3-stage crushing circuit and a traditional ball mill, and then CIL wet circuit. Nothing new or nothing sort of leading edge. I think that's part of the answer to your earlier question, and that is, how did we achieve in an industry leading way commercial production in such a relatively short period of time, when the industry typically takes a lot longer than the 3 months that we achieved commercial production in. The fairly standard nature of our circuit, the low downhill loaded haulage distances from the mine down the hill from the deposit to the plant in the valley, including waste facilities down in the valley, all contribute to both the efficiency of the ramp up as well as the costs that will be achieved in the ramp up.
Now, I listened to the conference call you had earlier this week about this, and you're talking about, there's a phase 2 expansion out there somewhere. What are you thinking of? What are the timelines on that?
Yeah, I think we mentioned at the time and in our press release last week that certainly the phase 2 expansion is now on deck for consideration. We didn't want to lose focus by thinking about that too early until we achieved commercial production on our phase 1 operation. I think we're now permitting ourselves to have a closer look at flow sheets, engineering, and timing of when we would bring that phase 2 into production. As you mentioned earlier, that phase 2 is projected to take our annualized production significantly in excess of 500,000 ounces a year, which will make it one of the largest gold mines in Canada and probably one of the largest gold mines globally.
Now, this is perhaps a good time to talk about balance sheet capital structure. With let's say, $2,000 per ounce margin, you'll be generating a lot of cash very, very quickly. You spoke on the call also about your intent to, now that you've reached commercial production, to refinance your existing debt. What are you thinking there? What will that look like? And then projecting forward to a possible phase 2, how are you thinking of financing that?
Yeah. Well, the first step, as you mentioned, and it's been in our playbook in predecessor companies of Artemis, the first step is to refinance the traditional project financing debt into a more of a corporate type facility that might take the structure of a corporate revolver with some of the international banks and Canadian banks that participate as lenders to the mining sector, but it'll be presumably more competitive and lower cost of capital because we're now in a cash flow state and enjoying significant cash flow margins. So a corporate revolver or even the corporate bonds are back on deck. We've had a number of our bank relationships present scenarios where we could look at some sort of a public debt security to refinance our project loan facility. And then turning to how we finance the next phase of expansion, I can envisage us, as part of our decision-making process, getting comfortable with being able to fund that expansion from cash flow. And anyone who has studied investment analysis 101 at university or college knows that the best return on capital for a capital investment is if you can manage to afford to fund that capital expansion and business growth from internal cash flow rather than diluting your shareholder base with additional issued equity, and or, as I said, a combination of that and some new debt facilities.
Now, reading your sort of previous, most recent communications and some of the webinars you've done, you seem very adamant that you're not going to do any more shareholders dilution going forward. In terms of refinancing, I guess, what are you looking for? Are you looking for additional flexibility on the terms, reducing your costs, reducing your payback time? Revolve would certainly do a lot of those things. What sort of cost savings do you think you can achieve by refinancing?
Yeah, the project loan type debt facilities generally have a significantly higher margin, sometimes 2 or 3 and even more in non-bank lender cases, margin above cost of funds. I think we can get much more competitive pricing, more appropriate to a corporate borrower with significant margins, as I said. Yes, we are adamant. In fact, Paul, we haven't issued equity in Artemis since October 2022 as part of our capital raising to fund the equity proportion of the capital spend for phase one. That's a function of the fact that we, board and management, own 38% of the company, and we treat our shareholders and our shares more valuable than money, and treat it like gold, literally. And so for that reason, we are very focused, more focused than most perhaps, and more aligned with institutional and retail shareholders to ensure that we maximize value for shareholders, and we look at all options in terms of funding that capital.
Well, the investors and shareholders certainly taken a shine to Artemis Gold. Your market capitalization has risen considerably. You're now over 5 billion Canadian, looking at the chart now, which puts you pretty much with a bigger market cap than most other mid-tiers, even though you've only just come into commercial production. Looking forward, one of the questions I imagine you get a lot is, you're obviously a single asset producer. There's a certain vulnerability to that. So now that Blackwater is in production, in commercial production, you're starting to think ahead about, okay, this is something that we may need to address in the future.
Yeah, you know what? I think the capital markets thinking on that, Paul, is changing, and there's risk in diversification, as well as risk, as you say, by being focused on one very large asset. And case in point would be Lundin Gold. It's a fabulous company. It's done particularly well. It's got a market valuation of, I think, in Canadian dollars, of the order of 14 or 15 billion dollars. They have a similar production profile to what we expect through phase two of production, and the capital market doesn't seem to be bothered by that. And so I think that the view on this is changing. I think the other factor is that you'll see us in our phase two deliberation and design and engineering introduce certain risk mitigation measures in our design that will reduce the sorts of risks that you're concerned about, by being reliant on, say, one ball mill, or relying on one crushing circuit, or whatever the other issues are. I think the future is going to give greater recognition and value recognition to a management team who are totally focused on making the most out of a very large world-class asset.
Now, interesting, you mentioned Lundin Gold. They're pretty much at the head of the class in terms of having a low all-in sustaining cost. And it looks like you're going to give them a good run for their money there. One of the other things that is perhaps driving Lundin Gold is that since they've brought Fruta del Norte in Ecuador into production, they've been able to start investing heavily again in exploration around the mine, and with great results. As you start generating and building your cash position, Stephen, is there still exploration potential at and around Blackwater that you're anxious to start looking for again?
Yeah, that's an excellent question. I think you'll see us start looking at that in the second half of this year, Paul, in two ways. One, the potential extension of the Blackwater deposit itself. It's a massive deposit. It's 12 million ounces. I think it's one of the largest, certainly one of the largest deposits in Canada, single deposits in Canada and perhaps North America. But we see it getting potentially bigger through extensions, particularly in the north, in the northwest, as well as in the south and the southeast, where the ore body is clearly open in those directions and at depth. So that therein lies some upside in terms of ounces to be produced in the future. These deposits, if you look at history and you look at some of the largest deposits around the world that are been producing for 20 or 30 years now in Australia and the US and Canada and elsewhere, tend to get bigger. they just tend to get bigger for all the reasons I said, the higher gold price, extensions of the deposit, etc. Then on top of that, we have about 1,400 odd square kilometers of exploration ground under tenure around the Blackwater deposit. The other factor with these large deposits is that they generally don't exist alone. And so we've got a number of targets that are drill ready that I expect will look to announce the commencement of a program targeting some of those already drilled targets with some follow-up drilling. And let's see what we can do with some of those other exploration targets and add to the mine life beyond just the Blackwater deposit.
I mean, that's very exciting, isn't it? And another way of adding ounces, and this is, I think, a current debate, a very current debate, is, we've got higher gold prices. Should companies be using higher gold prices in their reserves calculations, in their resource calculations, and of course in their mine plan calculations? You've got a slide in your presentation deck that talks to this. Your current pit shell, I believe, was designed at $1,400 per ounce gold, and you've put an estimate in that at $2,000 per ounce gold, that adds 3 million ounces in the current pit. A lot of people think, or there's growing voices that say that the consensus gold price estimate of around, let's say, $2,500 per ounce long term is far too conservative. What are your thoughts on that, and what could factoring in a higher gold price into your mine life calculations, etc., what could that do for Blackwater?
Yeah, at the risk of disappointing you, as I think I've said in our interviews before, I don't know where the gold price is going. What I do think the $2,200 to $2,500 per ounce is a pretty stable and probably conservative long-term view. You're right. We have optimized our pit in our current life of mine plan at $1,400 gold. Clearly, there's scope to revisit that, and I think you'll see us do that in the next 12 months. What that will mean is probably a slight redesign in the pit. It will probably drive the pit deeper and capture some of the ounces that are in our resource base. As you may recall, our resource base is of the order of 12 million ounces. Our reserve subset of that 12 million ounces is 8 million ounces in reserves. And what we would be doing by re-optimizing at a higher gold price, excluding any drill results, this is with zero additional drilling, capturing a larger proportion in reserve of that resource base, and therefore approaching the 12 million ounces of total resource.
I mean, that's a tremendous opportunity. Now, I'd like to broaden that out to sort of talking about, maybe as we come to a close, Stephen, more about the gold industry in general. You mentioned that, going back to a conversation we had a couple of years ago, how do you have a low-cost mine, build it? Obviously, much of the gold industry is already there. They already have their mines. How do you see the gold industry that Artemis is coming into? How good a shape do you think it's in? It does seem that despite high gold prices, companies are struggling to grow margins. And of course, some gold companies seem to not want to be gold companies anymore. Has the gold premium withered away?
No, I think there's evidence today that some of the best producers in the sector, particularly the large intermediate and senior companies, are trading. Agnico is a fabulous company and a fabulous example. I don't know exactly what their multiple is, but I think it's somewhere between 1.5 and 2 times PNAV. So it's trading at a significant premium to a 1 times NAV. And there are other examples, Lundin Gold I mentioned earlier, and there are lots of other examples: AngloGold Ashanti, Goldfields, Kinross, and there are more who are trading at a premium to that consensus gold price NAV. And I would like to think that Artemis is on its way to trade similarly because of its premium asset. yes, we're seeing some diversification away from gold by some of the big guys in town. I think that's a function of the fact that the industry really has a challenge in sustaining very high levels of production. And I'm talking about, in excess of 3 to 5 million ounces per annum of production. It's really, really difficult organically to sustain long-term that level of annualized production. And if you are going to stay a pure gold or precious metals producer, then I think the optimum is probably somewhere between maybe 2, maybe 3 million ounces. I think that's more sustainable for the long term. But 5 million ounces, which is what some of the seniors are doing, is much more challenging. So it's understandable that they diversify away a little bit, particularly in the areas of copper and copper gold type deposits, because in some ways the copper can result as a byproduct, can result in a very, very low cost precious metals mine. But the outlook for copper is also positive. So I understand why those companies are doing that. But as I said, I think they're also doing it because it's so difficult to sustain such a high level of annualized production on a organic basis. So that then leads us to the next question, which I think you're alluding to, and that is, is there going to be some more M&A in the business? I think absolutely is the answer, because for the very reasons that I just spoke to, it's very difficult to sustain long-term a growth business in this sector without a portion of M&A to supplement your organic growth, and that's just provided it's done in a smart fashion, in a fashion that doesn't dilute shareholder value over the medium to long term. Then I think we're going to see more of it. I also take a little bit of issue, if I may, with your earlier comment. If I look at the quarterly results, and you're looking at the same things as I am for the Q1 2025 reporting period, the vast majority of intermediate and senior companies are performing now. And yes, the costs have crept up a little bit. We were down. The industry was down at 800 or 1,000 AISC costs for a few years ago. It's probably now 13, 15, 1,600 AISC. But nevertheless, very substantial margins, and I think you're going to see companies adding very significantly to their cash balances on their balance sheets during 2025, 2026, if precious metals pricing stays where it is.
Point taken, Stephen. Looking at the results, there's a good number of companies that have more than a 50% all-in sustaining cost margins, which means they're putting on let's say $1,500 per ounce into their cash position. So cash positions are growing, and a number of companies are using that to return cash to shareholders. Specifically, a lot more companies are doing share buybacks and being much more aggressive with their share buybacks. They're obviously using that to great advantage. Stephen, let's end on Artemis Gold. You've just announced, obviously, a very big catalyst. What are some of the other catalysts to come from Artemis throughout the remainder of the year?
Well, I think we've touched on a few of them already, but refinancing of our project debt facility is probably next on deck over the next 3 or 4 months. Our first post-commercial production quarterly report for the Q2 2025 period, which will be a 2-month period for us, not the 3, but the 2-month Q2 production stats and costs. And in the second half, the phase 2 expansion is likely to be on deck for consideration for our board. We're probably going to look at whether we tweak that phase 2 from the design and the optimization study that we released last year to see, it might be a phase 2.2 or a phase 2.5, given what we know about the performance of the installed hardware in phase 1, for example, and what it's capable of. And of course, taking into account the current precious metal prices, will factor into how quickly we get this mine up to 18, 20, maybe even 30 million tons per annum of processing capacity over the next several years.
So it sounds like there's a lot more good news to come out of Artemis Gold. Stephen Dean, thank you very much for joining me today.
Thanks, Paul. Always good to see you.
And of course, to our viewers, if you like what you see, don't forget to hit that subscribe button. I'm Paul Harris, and this is Kitco Mining.